In this presentation, we will discuss the definition and the concept of the basis or cost as it relates to the sale of property. For more accounting information and accounting courses, visit our website at accountinginstruction.info. The term basis is one we'll often hear when we're talking about taxes, and it can seem like an intimidating term. However, the concept of basis is not complex. The concept of basis usually is the cost. So when we're talking about the sale of property, we usually need to calculate the gain or loss. In order to calculate the gain or loss, we need to know the cost or the basis, and we need to know the sales price. Now, there are some adjustments, which is the reason we need the term basis. It doesn't always just simply equal the cost, but most of the times that's the starting point, and many times that's the ending point. So then we can ask, what exactly is cost? What exactly is cost if cost is similar to basis or a major component of basis most of the time? When we consider the cost, we're talking about what we paid in cash. Clearly that would be part of the cost, but we're also talking about the debt that was incurred in order to purchase something and other property or services included in acquiring an asset. In other words, we're talking about an asset that we purchased. We're talking about what was the cost of it, which will in essence most of the time be the basis of it. And we're not just talking about the cash we paid for it, because we may have financed it. What if we financed this, whatever we purchased, this piece of property? And if we did so, then we paid some cash and we incurred some debt. So you can kind of think of it as the sticker price. You could say, okay, the sticker price of whatever we purchased is really the cost of it, whether we paid cash, whether we took out a loan for it, or whether we paid with something else. Maybe we bartered in some way, gave some property or services in exchange for the property that we purchased. In either case, either of those things, all of those things added together would be the cost of it, which again, you can kind of think of as the sticker price and not really the payment form that we're using here. So now we say, yeah, general rule, if we purchase something, the cost is the basis is the cost. But what happens if we have something unusual like an inheritance? If we had an inheritance, we inherited property, then we don't have a cost. What do we do about the basis here? And why is that important? Because we need to put it on the books at some point. And if we sell it for taxes, we got to know what the gain or loss is. In order to know the gain or loss, we need to know usually the cost or basis. And if we inherited it, then it's more difficult to know that. It's going to be the fair market value at the point of death. So the basis for inherited property will be the fair market value. So if we were to sell something, some property that we inherited, then we're going to have to think about it and say, okay, well, what was the cost of that property? And we'll have to go back to the point of death, and that's usually because if there was any inheritance tax or something like that, you could think of it as having taken any tax payment at the point of death with any kind of death tax. So then that means that if we get it as inherited property now, we should have it at the fair market value at the point in time of death. And so that's going to be for inherited property basis. However, it's not as easy to do that as we would think. We'll have to figure out, what is this piece of property? How can we figure out what the fair market value was at that point, given the fact that we're not selling it? We didn't sell it at that point. That's the way we know the basis or the fair market value usually. When we bought property, it had a fair market value at the point of purchase because we bought it on a free market. And if we're talking about an inheritance, the concept is clear. We'll take the fair market value at the date of death, but the way to do that's a little bit more difficult. We might need an appraisal or some other type of method in order to do so. Then we have the situation of a gift. A gift, once again, has no cost, has no basis. If we sell something that was gifted to us, then what are we going to record it on the books for the gain or loss? We need the sales price, we need the cost or basis in order to calculate the gain or loss. And the gift is a little bit more complicated. It will be the fair market value or basis of the donor, depending on the fair market value or whether the fair market value is less than or greater than the basis at that point in time. In other words, if we're talking about normal kind of equipment that goes down in value, so they purchased it, let's say they purchased it for $50,000, it went down to $20,000 at the point in time of gifting, then we're going to use the fair market value at the point in time that it was gifted. If, however, it goes up in value, and this would be something like real estate. If we're talking about real estate, maybe the cost of the real estate, hopefully it went up. Well, in that situation, we're actually going to have to take the donor's basis. And you can see that that's an actual disadvantage here, because that means that we're going to have a larger gain on the point of sale and therefore pay more taxes. So in other words, if real estate was purchased, then we're going to say that it was, if it was purchased for $100,000, gifted to us, and it went up to $200,000, then we're not going to get the $200,000 at the point of the gift. If it was gifted to us at $200,000, that's the fair market value. If we have to take the lesser of, and therefore we got to take the basis that was purchased at for the donor, which is the $100,000, which means when we sell it, we're going to have to realize that gain and pay taxes most likely on that gain at the point of sale. So notice that difference between the inheritance and gift. They're similar in some respects, but the gift, in terms of property that will go up in value, which is oftentimes real estate, other property will typically go down in value. So if we're talking about normal equipment, it'll typically go down. But things that go up in value, then the gift, we typically have a disadvantage because we have to assume the cost of the donor. The same is for stocks. Stocks is another area where the stock could obviously go up in value, and the gift could be a detriment in that case because we'd have to take the basis of the donor, whereas if we inherited it, we may get that step up in basis, it's called, and be better off in terms of the selling of it, recognizing less gain and therefore less taxes on it. So if we look at a calculation, we got the cost less the depreciation. That's the adjusted basis. So we got the basis now. Now, what's the adjusted basis? We have to take into account depreciation if there is any. So the adjusted basis is going to be, for example, the cost is $15,000, and then we have to consider the accumulated depreciation. So depreciable property will have depreciation on it. We've got to consider that, and then we subtract the two out, and that'll give us our adjusted basis. The adjusted basis then in this situation is what we're going to use in order to calculate the gain or loss. So we've got the sales price minus the adjusted basis, in this case giving us a gain. And of course we can see the same situation where we may have a loss. Adjusted basis, same adjusted basis. If we sold it for $5,000, then we would have the loss of the $3,000. For more accounting information and accounting courses, visit our website at accountinginstruction.info.